And our next speaker is Habib Akiki, Senior Market Strategist at XM, and he's going to be talking to you about the key market trends and best trading opportunities.
Good afternoon, guys. Good afternoon and welcome. Crazy times we are living, yeah? Already 2 years have passed since the pandemic and we are still going on. Now, during this period, COVID crashed the financial markets. But in no time, and due to the unprecedented stimulus packages done by governments and central banks all around the world, this has sparked a huge recovery. Now, among the various asset classes, the most favorable go-to market was the equity markets, the stock markets. After dropping by around 35%, we over doubled in value during 1 year. Another market which is basically attracting a lot of participation from retail and institutional clients mainly is the bond market, the treasuries. And commodities, the recovery in the global markets, the supply chain disruptions, and also inflation has caused a huge rally in commodity prices. Nearly all commodities are back to pre-pandemic levels. Even most of them are at levels higher than they were before the pandemic. Also, investors are hypnotized by another market, the crypto market. Everyone wants to trade cryptos now. You know, this market, in less than 1 year, the value of all cryptocurrencies has moved up from 300 billion to 1.9 trillion. So, with all the volatility going on in the market, which asset classes should we invest in? Should we go for the stock market? Shall we invest a little bit in bonds, buy commodities, cryptos? What shall we do? To better understand, I want to show you a little bit of historic data. If we look at the historical returns for the last 20 years, you notice that the REITs, you are familiar with REITs, real estate investment trusts, which are companies who finance and own income-producing real estate in different sectors. REITs, this is a REITs ETF, okay, Vanguard ETF. This ETF has produced over 10% on average over the last 20 years. Among the good asset classes is the equity market. You can see that the total stock market, the US total stock market, that is large cap, small cap, and medium caps, averaged 9.8% for the last 20 years. Of course, large caps as well are closely similar to it, with 9.2% average annual return over the 20 years. Gold is a good performer. Gold also generated over 9.5% yearly over the last 20 years. And then you can see the bond market with 4%, the commodity market 2.5%, and cash generating only 1.1% on average. So if you have cash in the bank, my advice to you is to better put it somewhere else. Choose anything else. Buy whatever you want. Just don't put it in the bank. They are not giving us any interest. Okay, so wherever you invest your money, you are better off. Now, if we take a look at the last performance, the yearly performance, notice that REITs this year went up 29%. Of course, there is no surprise that the stock market is doing really well as well. The general stock market is up 20% this year, 21% last year, and in 2019, 30%. Huge growth in the stock market. Now, what shall we look at? Gold. Gold this year is down 4.5%. But the year before, in 2020, it was up around 25%, and in 2019, around 18%. So huge volatility in the gold market. But overall, as we've seen before, for the past 20 years, gold is still stable around 9%. Commodities, this year, 30%. Huge rally in commodities. Of course, due to inflation and supply chain disruptions. But if you notice, there's a huge difference in the yearly return for commodities, while cash is always stable and the lowest. Now, to better understand where we should invest, we shouldn't look only at returns, but we should also take into account the drawdown or the volatility. Now, for that reason, I prepared this table here, showing you the 10 years compounded return for these asset classes. So when we talk about REITs, real estate investment trusts, for the last 10 years, they generated 181% return with a minimal drawdown of 25%. Of course, the best asset class here are the stocks, on compounded 350% for the last 10 years, with a drawdown that barely exceeds 20%. So does this answers your questions about where should you invest? I think there's the clear image here we can see. Notice gold. Although gold is a very good investment in all portfolios, notice the volatility and the drawdown in the last 10 years. 42% drawdown, 42% drawdown, and an average return, compounded return of minus 4.5%. Okay, but for the last 5 years, the return is much better, if you notice, 36%. So huge volatility in the gold market. Of course, commodity is the worst, in my opinion. For the last 10 years, 62% drawdown for a compounded return of minus 34%. That is not good. But the worst in all the studies we can perform here is cash. So don't hold cash if you don't want to use it. Invest it anywhere. So where shall we invest? Let's start with the REITs. Guys, are you familiar with REITs, real estate investment trusts? At 14%, commercial real estate is the third largest asset class in the US investment market. Now, to participate in commercial real estate, you can simply go and buy a property and rent it out. It's a good investment. But if you want to skip all this hassle, all you have to do is buy REITs ETF. Now, REITs historically have delivered competitive total return based on high, steady dividend income and also moderate capital appreciation. So people who are looking for continuous income should invest in real estate trust funds. Now, why REITs give us a steady dividend income? Because simply they are required to distribute 90% of their taxable income to their investors annually. So they are a good investment for everyone who is saving for his retirement, but also a good investment for people who are already retired and they want an income basically to fund their daily expenses. REITs have delivered over 10% return for the last 20 years. And if we look back at the past 40 years, the average annual return exceeds 11.5%. Imagine that all you have to do is buy a REIT, buy a real estate investment trust, and you will be earning over 10% yearly. How much is your cash giving you in the bank? Or even speculation in the market, how much is it generating in profits? Question is, should we invest in REITs? My answer is definitely. Okay? One good competitive advantage is that REITs is not correlated by a big extent, to a large extent, with other asset classes, especially with the US and global stock indices. We have a relatively low correlation, so REITs are a very good diversifier that we can have in our portfolio. Now, when we talk about the stock market, what do you think? The stock market, of course, the pandemic hit, the market crashed 35%, but ever since March of 2020, the stock market bottomed and the fast recovery started. This recovery, of course, was due to the unprecedented stimulus packages by central banks and governments. From March 2020, the S&P is up over 100%. To be precise, 101%. The Nasdaq is up 124%. Let those numbers sink in. The stock market value have doubled in less than a year, or in slightly over a year. Question is, shall we invest in stocks, or is it too late after all this rally? I think, in my humble opinion, we are still in the early stages of the bull run. So, and in my opinion, it's never too late to invest in the stock market. You can buy even when the market is printing new highs, is at its highest values ever. Don't be afraid to invest in stocks. Now, I believe we are still in the early stages of the bull run due to many factors. First, the equity market is enjoying an increased interest and participation, not only from institutional clients, but also what we've seen lately, increased interest from retail clients. Last year, it is estimated that the brokerage industry added 10 million new accounts. 10 million new accounts. Those accounts are all for retail clients. So all retail interest is pouring into this market. And it will continue to, because once you start investing and trading, you never stop. Now, stock holdings among Americans are at 41% of their total assets. 41% of the total assets are in stock holdings. This is the highest level on record ever. Another factor that contributed to this huge growth in the stock market is the cash at hand. The excess liquidity among investors. Guys, even before the pandemic, the cash at hand was at very high levels. And when the pandemic hit, when COVID hit the market, cash hoarding even grew more. And it was only reasonable for some of this cash to find its way to the stock market. Now, why the excess liquidity among investors? To understand that, we should basically differentiate between what happened in 2008, so the quantitative easing of 2008, and the quantitative easing of 2020. In 2008, after the crash, the Fed increased its balance sheet from 800 billion to 4.5 trillion. But this is over the course of several years. And this printed money, basically, the purpose of it was to recapitalize the banks and restore confidence in the economy. Actually, none of this printed money was injected in the real economy. Now, in 2019, the story is different. After COVID, the Fed started QE again, but this time printed in matter of weeks $3 trillion. And this time, the money was given directly to consumers to spend. They were given to companies to retain the employees. And that is why we witnessed this unprecedented excess in liquidity. And this liquidity went to the market and is still finding its way to the stock market. Now, one more very important factor that will sustain this rally is the lack of an alternative investment. Now, if I ask you a question, where do you invest your money? You have $1 million. Okay, maybe not all of us, but don't think about retail clients. Think about hedge funds, mutual funds, big investment funds. Where do they invest their money? With interest rates non-existent and low treasury yields, where do they invest their money? They have no other alternative than the stock market. And I believe that as long as the 10 years treasury yield remains below 2% and the 30 years yield remain below 3.5%, investors will have no alternative investment but to invest in the stock market. And even if the Fed now is on its way to start tapering and hopefully increase interest rates, the rise in interest rates will not happen until few years down the road. So now the expected increase is 0.25% end of 2022. So we have still at least 1 year of low interest rates. And investors will always favor the stock market. Now I understand that with the inflated valuation and due to this unprecedented rally, we could be on the doors of witnessing a large market correction. This is totally understandable. Let's take a look at the chart to better understand what's going on. If we look at the chart, this is the chart of the S&P. This is here the low of March. This is the lowest point reached, March 2020, and this is the rally ever since. This is the monthly chart, so every candle is a month. Did you notice a thing here? Look at this rally. Look at the slope. This is not sustainable. Okay, for everyone who practice technical analysis should know that a steep trend is not sustainable. So a correction could be on its way. Actually, it just started. We broke this uptrend. Now, in technical analysis, we believe that a decent correction should be between 1/3 to 2/3 of the directional move. So if we take this directional move from the low to the high, from March 2020 to the all-time high, let's consider a correction based on Fibonacci retracement levels. A 23.6% correction would be at 3,990. A 38.2 correction would be at 3,650. And a 61.8% correction would take us to 3,090 levels. Where will the market, how much will the market correct? We will never know. Guys, if the market corrects 61% of this big move didn't correct yet. No retracement for this move. So because it's a very steep move and because the drop will create panic and a lot of profit taking, I think the correction could be also deep. So if we reach a correction of 61.8%, that would be only 60% of the last move, but only 30% of the total value of the index. From 4,500 to 3,100, that's roughly around 30%. That is a very good correction if reached, if the market managed to correct this low. So my advice to you, where do you buy? I always get asked this question. When shall we buy? Well, buy in tranches. Don't buy with all your money at once. When the market reaches 4,000, buy some. If it kept going down, buy more at 38%, at 3,650. And if it reaches 3,100, buy with everything you have left. This is what you should do. Don't complicate things. Find an ETF, SPX, okay? It tracks the S&P 500, so you will be looking to the large cap US stock market, and just buy it. Take part in this rally. The growth will continue for years and years to come. For the last 20 years, returns over 10%. What do you want more? Now, let's talk about crypto. Big fuss about crypto, yeah? Everyone wants to trade crypto. With no doubt, the growth on this market was basically due to the participation of the cypherpunks, developers, and tech freaks, unlike myself at all. I am not even close. But now, lately, even institutional investors are pouring their money in this market. So, should we invest in the crypto market? Guys, this market is attracting institutional investors like never before. The crypto market has grown at a rate unheard of in other financial assets, and is expected to keep growing based on many valuation estimates. Now, Bitcoin is becoming a safe haven. It is serving as an inflation hedge, and according to many analysts, Bitcoin could become the gold of the 21st century. So, institutional money, as we said, is pouring into the crypto market. Activity from institutional investors seems to be picking up. $17 billion of institutional funds entered the crypto world this year. What does this tell you? When funds and money managers like BlackRock pour their money in this asset, I think this asset is there to stay. Of course, volatility has always been the downfall of crypto. Volatility is in a different league when compared to other asset classes. But volatility is taking a turn. More institutional investors, more liquidity, also a derivatives market is being developed, and this will help reach a more sustainable market. So should you invest in crypto? Simply yes. Invest in crypto, but don't trade crypto. Invest, don't trade. There's a big difference. Buy and hold for the long term. Buy with 5 to 10% of your portfolio, not more. Now, when you want to buy crypto, buy with crypto exchanges. Don't buy with Forex and CFD brokers, because you want to buy and hold them for years. And buy well-established coins with strong fundamentals. Don't buy meme coins, you know what I mean. This is how you should invest in crypto. And last but not least, because time is up, I wanted to talk about gold. Now with the Fed expected to start tapering, with interest rates on the verge of rising, many factors have to be taken into account when we talk about gold. But just to simplify things, investors will always buy gold, okay, to protect themselves from volatility and uncertainty. And even although it's a highly volatile commodity, it has proven that over the long run, gold will provide good returns, and it should be part of any portfolio. And for everyone who thinks gold is gonna crash like it did in 2013, I don't think so, because gold is, of course, inversely correlated with interest rates, but what affects gold more is real interest rates, which is interest rates minus inflation. And because inflation is expected to rise and keep rising in the coming years, real interest rates will always stay low, near zero, and this will give support for gold. Also, gold in 2008, 2013, 14, 15 crashed, not only because interest, actually let me show you this. Look here, inverse correlation between, we are seeing real interest rates, not interest rates, real yields, and gold in yellow. We have perfect negative correlation here in the crash of 2013-14, and also perfect negative correlation in 2019-2020. However, notice here what happened. This is real yields. They went up, gold crashed. Okay? Notice here what happened. Real yields went down, but gold did not go up. Why? Because gold is also correlated to the dollar, and the dollar witnessed a huge rally during the period of 2014-2015 due to the divergence in the monetary policies between the Fed and the ECB. The Fed was raising interest rates and the ECB was lowering interest rates, and this is why the dollar witnessed a huge rally. Look here. This is the rally of dollar in blue, and this is what prevented gold from going up as real yields went down. Now, do you expect gold to go up in the coming years? Yes. Do I expect Do I expect the dollar to go up in recent years? Yes. In the coming couple of years? Yes. At the same pace it went up in 2014 and 15? No, because now all the monetary policies are aligned. Okay, everyone will start tapering. All the central banks will start tapering. Okay, one faster than the other, one sooner than the other, but they are all aligned in their policies. Inflation is global, and they will need to raise interest rates. So I don't think the dollar will witness the same rally. So just to sum everything up, it is pretty simple, guys. If you have cash in the bank, take it away, buy ETFs. 10% gold, 5 to 10% in crypto if you are young and you want to take part of this market, 30% in REITs, and 50% in stock ETFs. It is very, very, very simple. No need to complicate things. Now, if you want to trade, if investing is not fun for you, you want to trade, I can help you. We at Tradepedia, we train traders. We teach you how to trade and speculate properly in the market. We teach you technical analysis, we teach you fundamental analysis, we teach you money management, and we teach you discipline. And now we partnered up with XM brokers, and we are delivering live educational seminars every day. By being a client for XM, you can join these educational rooms every day, 7 hours every day of live education by myself and my fellow colleagues, the analysts from all around the world, in multiple languages. If you want help, come to us. We'll help you. We'll give you technical indicators developed by our own team that will do the analysis process for you. So you will have more time to trade rather than spend hours analyzing the market. But we teach you how to do it properly. If you don't want to learn how to trade properly, don't burn your money. Invest. And if you want to trade, let us teach you how to do it properly. Or else you will lose. Education is key. And this is what XM and Tradepedia are doing. Okay, we have amazing tools, amazing indicators. You put them on the MT5 platforms, they give you the signals, where to buy, where to put the stop loss, where to take your profits. But we also teach you how these indicators work, so you know what you are doing. We teach you money management and risk management to know how much to risk on every trade. Thank you very much. It was a pleasure being among you in these times. If you have any question, I'll be at XM booth number 10, to answer all your questions. Thank you very much.